Hello and welcome to Market Domination. I'm Josh Lipton, live from our New York headquarters. There's just an hour to go until the closing bell, and stocks are looking to stage a comeback here following Monday's risk-off sentiment. Let's welcome in Jared Blickery, joining us to break down all the headlines. Jared, what are you seeing in the markets, my friend?
We are seeing a nice reversal from yesterday, call it turnaround Tuesday. Let's start with the Dow here, up almost 0.5% or just over 200 points. If the Dow had a heartbeat, this is probably what the electrocardiogram would look like. In other words, it's kind of this is what you expect to go into the end of December, except the volatility will be shrinking and shrinking and shrinking. We still got some action here. Here's the NASDAQ, it's up 0.75%, also a very choppy chart today. Here's the S&P 500, up about half of that. And you know I like to go to the Russell 2000 to get a gauge on the small caps. And after a nice pop here, just kind of winding down and consolidating in a tight range over the last few hours. We'll see if it breaks out into the close and which direction that signals. And just got to check in on the VIX volatility index for half a second. It's down a little bit. It's been coming steadily down since the last volatility scare a couple weeks ago. And just checking in on the bond market as well. Another reversal here, just like stocks, except this is yields to the downside. They were up quite a bit yesterday. We saw the 10-year up about 8 basis points, down 1 today to 4.08%. 30-year down to 4.74%, and that's down only 1 basis point. And the U.S. dollar index, which ended the day pretty close to flat again today, although we did see some hiccups yesterday morning. I'm going to zoom ahead here to the sector action, and guess what is in the pole position? That would be tech, the AI story. Is it alive? Of course it is. It's Christmas. Here, tech is up 1.11%. Industrials and communication services, those will be your outperformers of the S&P 500. Financials and discretionary also in the green here. Energy was yesterday's big gainer, and today is the biggest loser. It's down 1.4%. Materials, staples, utilities, healthcare, and real estate also in the red there. And let's get a read on the NASDAQ 100, where we're seeing a nice smattering of green around here. You're going to see Apple, that's up 1.1%. This will be the 7th day in a row that Apple has closed in the green, if it holds on to those gains, and also looking like the 6th record close in a row. So that would be an interesting streak. Another streak I've been watching here are the semiconductors. Now the NASDAQ ended its 5-day streak yesterday, but the semiconductors are keep on going here. The SOX, the Philly SOX chip index, that is going to be up 7 days in a row. Intel here up 8%, Applied Materials up 4%, Texas Instruments 5%. So some of the smaller bets in the chip name really being the outperformers today. And we got to check in on software as well, where we're seeing nice smattering of green and dark green. Shopify up 6%, Snow up 3.5%, and a lot of other names. MongoDB, the outsized performer in the NASDAQ 100 today, that is up 23%. I'm going to close with my leaders here, and in the number one position is Bitcoin. We got Ines on deck. She's going to talk to you about all things crypto, but aside from that, we got SOX, that's that chip index I was talking about. Then we got the quantum trade, the disruption trade, South Korea, software, internet, aerospace and defense, which was one of the biggest losers yesterday. That is the top row there. And then one of the bright spots yesterday is the biggest loser today. That would be China internet, also biotech down. So again, just kind of flipping over from yesterday. It's nice to see that going in the right direction here. And I'll send it back to you, Josh.
All right, thank you, Jared. Appreciate it. Now let's get a check on the crypto market. Bitcoin holding on to gains, now hovering just under 92,000 a token. Ines Ferré joins us for more. Ines.
Josh, a reversal from what we saw yesterday with Bitcoin up more than 7% right now, hovering just around the $92,000 level, just below that, really sort of catching up with the broader market. A series of headlines may have been also helping here as well. You have the SEC Chairman Paul Atkins in an interview talking about plans to unveil an innovation exemption for digital asset companies. You also have Vanguard Group that has said that they are going to be allowing ETFs and mutual funds, primarily holding cryptocurrencies, to be traded on its platform. So this is all bullish for Bitcoin and the rest of the crypto market. You're looking at Ethereum that's up more than 9%. A big reversal from what we saw over the last couple of days yesterday over concerns about an appreciating yen. And you also had concerns about strategy and whether it would be forced to sell Bitcoin at some point. Then they subsequently announced that they are building a reserve fund, a US dollar reserve fund to pay out dividends. So that should tie him over for a couple of years should the volatility in Bitcoin continue. But if we take a look at the crypto related stocks and the bounce that we're seeing today, you're looking at Strategy that's up more than 8% year to date. The stock is still down 35%, but nonetheless, a rebound from what we saw yesterday. You're also looking at Robinhood that's up 4%, also rebounding from yesterday when the whole sector was really under pressure. And Coin up more than 3%. Coin, by the way, in December 17th, is going to be unveiling some offerings, including prediction markets. That's huge in this space now, and tokenized stocks as well, as it aims to just further go into a sort of an everything exchange, really kind of competing quite a bit with what Robinhood has been doing as well. Josh?
All right, thank you, Ines. And joining us now with a look at investing strategies ahead of the year's end, let's welcome in Huntington Private Bank Director of Wealth Strategy. That would be Dan Griffith. Dan, always great to see you, especially on set. Maybe we'll start there, Dan. Continue this conversation on Bitcoin. Just curious, get your view on Bitcoin and how you think about, Dan, that relationship between Bitcoin and the equity market. I asked if I've had some strategists on the show, and they're not crypto guys, they're equity guys, but they're watching Bitcoin closely.
Well, I think everyone needs to be aware of what's going on there. We at Huntington are evaluating it really closely. We get questions about it every time our clients are coming in and asking about it as well. I think one of the biggest things to look at when you're talking about crypto with your clients is why are they asking? Is it they're asking because they're concerned about risk, they want to diversify? Are they concerned about what's happening in the economy more broadly? Or are they genuinely excited about what blockchain technology can offer? Usually if you find out what that is, what's the reason behind their request, you can get a little more into whether or not it's the right thing for them to do.
I saw a headline today, Dan. I thought I'm going to ask Dan about this. I don't know if you saw this one. Bank of America, Dan, this isn't your wheelhouse. They say its wealth management clients should start thinking about getting some crypto exposure in their portfolios. The firm is endorsing, I want to get this right, a 1 to 4% allocation to digital assets for clients. You see a headline like that. What do you make of that? Is that smart guidance?
I think it's good to consider diversification in all of its forms, and crypto is one of those areas to think about. Again, I think you need to make sure that you're going into it in the right way. Just because somebody talks about a sector doesn't mean that the particular instrument that you're involved in is the safest one. So that's the first question is, does it make sense? But the second place is, if you're going to jump in, are you jumping into something safe? With crypto, one of the real concerns is that there's a legitimate risk of loss if you don't do it the right way. And so you got to make sure that you're in things that are safe, products that have some sophistication to them.
More broadly, I like this, what you call the duality of how people feel and what they're experiencing, Dan. Walk me through that. What do you mean?
I think as we talk to a lot of business owners these days, many of them are experiencing two different things that are very, very at contrast with each other. The first is they're having a lot of concern relative to the headlines that they're reading. They look at what's going on in the markets, they talk to other people around them, and they say, I'm really worried about the economy. And I think everybody is experiencing that to some degree. Worry is a real thing. But then if you look at what's actually happening, if you ask a business owner, how is business? Many of them are experiencing really good things. Many middle-class Americans are experiencing balance sheets that look really good. The problem is the duality of that means people, they are experiencing positive things, but they don't necessarily translate that into optimism for the future. And that's a concern, I think, as we move into 2026.
Well, you noted here, speaking of looking ahead, you said the consumer spending has driven a solid 2025. But then it sounded like, Dan, you were sort of offering kind of a bit of a warning sign there about who exactly is doing all the spending?
We're concerned about 2026, I think, is going to largely look one way or the other, depending on which headwinds and which tailwinds come into play. And consumer spending is one of those. If we see some of the benefits of the tax plan that passed this last July come to fruition as we begin to turn the calendar into next year, that could push a little bit of consumer spending. Many seniors, as an example, are going to get tax returns back that are a lot higher than they expect. I joked it's going to be hard to book a Viking cruise next year, maybe in the fall. So those things are some surprises for benefits for businesses businesses. For example, you've got accelerated depreciation and the 179 deduction. All those could push CapEx spending. If they come to fruition, the economy could have a little bit of a tailwind. If we see, on the other hand, some of this headwind that we've traditionally seen, if trade imbalances continue to be a problem, if we don't see interest rates kind of make significant moves, that might be the story we see in 2026.
So do I broadly, Dan, if I add up, am I trying to position my portfolio broadly for kind of, is it moderate growth, sticky inflation, and plenty of, it sounds like policy questions?
I think that's right. I think that, we're still very optimistic about what the future has to hold when it comes to equities. I think obviously diversification, as we mentioned earlier, is always a good policy, and now is the time to be doing that and exercising that discretion and discipline as much as it ever was too. But we're still very optimistic about what 2026 has to hold. If we look back and see where we were a year ago, I think people were not as optimistic about 2025, and yet we had many quarters of successful earnings reports. The markets have continued to show real growth based on good, solid fundamentals. We don't think that there is a lot of that's going to change when we move into 2026.
Does that AI story still look intact to you?
I think so. I mean, everybody is asking the question, how is AI going to make a difference in my life and as a result, the lives of my businesses? And I think some of those efficiencies are going to come to fruition. We're spending a lot of money as a society creating the infrastructure. That investment probably is going to lead to something one way or the other.
I want to end here quickly. Dan, Huntington added 4 new stocks recently.
Yep.
Got Walmart, got CrowdStrike earnings on deck after the bell. We'll cover it. SLB and Corning. Are there certain common themes and trends kind of tying those names together, Dan? What are you screening for?
You mentioned AI as an example, and I think for 2 of those plays in particular, that AI is going to be an important one. Corning is a huge AI play. Many people don't appreciate this, but Corning is very closely tied to the AI data center development area. So for a lot of our clients who are asking, how do I get involved in investing in AI data center development, Corning is a good example of that. They obviously also have a huge contract with Apple to develop a lot of their stuff too. Walmart's another good example. They've done a huge amount of investment in their logistical and AI technology, gathering information on the consumer and then being able to translate that into better results overall. So I think those are 2 examples of where AI is starting to show some fruition and has a higher likelihood as we move forward.
Dan, always a pleasure to see you, sir.
Always glad to be here. Thanks for having me.
Well, the founder of Dell Technologies is embracing the season of giving. Michael Dell is set to gift billions of dollars to supplement new savings accounts for young children. And Yahoo Finance's Washington correspondent Ben Worschel joins us now with the details. Ben.
Yeah, Josh, so this is a $6.25 billion gift from Michael Dell. He's actually formally announcing it at the White House right now as we're talking. It's from Michael Dell and his wife. The money here will go to the U.S. Treasury, which will then be distributed in $250 increments into about 25 million of these Trump accounts. This is alongside money that was allocated by Congress to give $1,000 to newborn children. This money will go to children 10 and under, so kind of expanding the pool of kids able to access these accounts. These accounts are intended to you set it up at birth. Your parents or your employer can contribute up to $5,000 annually, and then you access it after age 18 to kind of give you a jump start on things like education and buying a new home. What we're also seeing today from this White House event, but also throughout the day, is kind of a real push to get more folks involved, more philanthropy, more billionaires giving to it, but also getting companies involved in this too. So we're seeing a big push in that way. One interesting voice on that side is Cory Booker, this Democratic senator from New Jersey. He's not at the event, I don't think, but Ted Cruz is another senator. They co-wrote a letter to the Fortune 1000 CEOs saying you need to sort of get involved in this. They essentially clearly a push here to make this a benefit for employees. Alongside your 401k, the companies can give up to $2,500. So that there's an effort to make that part of your benefit going forward, even as there is skepticism about how involved parents will be able to be in this, given some kind of limited tax advantages you get from contributing your own money towards this account.
All right, thank you, Ben.
Sure thing.
Coming up, we take a look at the latest sales data from the biggest automakers. That's next on Market Domination. Two of Wall Street's biggest firms say the AI boom is far from a speculative mania. For more, we're bringing in now Yahoo Finance senior reporter Allie Now. Allie.
Hey Josh, yeah, and we've been talking a lot about this year, whether or not we're in an AI bubble. And I went to these outlooks from both Bank of America and BlackRock, and the messaging was clear. We are not in an AI bubble. In fact, BlackRock said we don't think the bubble framing is that useful at this stage for investors, because when you place a sort of backward-looking metric or assessment, it means that you're going to have an incomplete picture of what's currently happening, especially since this AI build-out is so unprecedented at this speed and this scale. So this comes as earnings have been really strong for a lot of these big tech companies. We have a spending boom that's so large that it's actually becoming a macro story, and the expectation is that that could continue to boost domestic growth. BlackRock saying that we could see a new wave, a new industrial revolution from AI, which could lead to sustained growth above 2%, which we haven't necessarily seen historically. And given that we have all these AI tailwinds, BlackRock is very bullish heading into next year. They are still overweight U.S. equities, and they do see AI driving new earnings pools and productivity gains across the economy. B of A, same kind of optimism, but also with a bit of caution when it comes to where we could see the AI trade head in 2026. So the firm saying that breadth and lofty multiples rhymes with the 2000 boom and bust, but that recommended stock allocations, they're much lower than we saw in 2000. Earnings growth has supported those higher valuation. IPOs are smaller. Speculation in unprofitable tech stocks is less extreme. So overall, they say we are definitely not in an AI bubble. However, all that being said, we could see an air pocket of sorts. So what does that mean? It means you see CapEx spending aggressive. The pace of sales is not actually rising at that same level. So the proof in AI may not come in 2026. And we've seen that before, how that could potentially spook investors. But Josh, the fact that we have any questioning at all about whether or not we're in an AI bubble, that's another thing that a lot of strategists note, because typically if there's any amount of skepticism in the market, skepticism around the bubble talk, that means we're not in one.
No, yeah, right. So all this talk about a bubble reduces the risk of a bubble.
Exactly.
Right.
You don't have that irrational exuberance like Greenspan talks
So
about.
lots to talk about AI. You know, another theme, the K-shaped economy, is a hot theme, a hot trend. What did you hear there?
Yeah, I mean, BlackRock described it. It's K-shaped everything, right? We have a K-shaped stock market where you have equities tilted towards tech. You have a K-shaped economy where you have those higher income consumers boosting growth while the lower income consumer is struggling. And I asked Bank of America specifically about this, and their economist, Adate Bave, he told me that the two can't coexist forever. At some point, you're going to have something break. However, B of A is pretty optimistic. They see GDP growth going to 2.4%. And part of that view is that the bottom of the K is going to stabilize before the top of the K collapses. And that's really underpinning that more optimistic view there. But what he did say that was interesting is, even though a K-shaped economy is not necessarily sustainable, what do consumers spend the most money on? Services. Would you say the higher income consumer spends on services or the lower income consumer spends on services? It's actually the higher income consumer. So if we continue to see spending on services, that could prop up that area of the labor market, and that could maybe make up for some of the softness that we've seen there. So even though a lot of the soft data, a lot of the survey data has been a little bit pessimistic about the state of the economy, and in particular the labor market, there are still things to like within this K-shape. So really interesting conversations. And Bank of America also said that they do not see us entering any type of recession next year either.
All right. Broadly positive, constructive.
Yeah.
Thank you, Allie. Appreciate it. Well, rising competition with AI models places OpenAI's ChatGPT in the hot seat, as CEO Sam Altman reportedly declares code red now. Yahoo Finance's Dan Howley joins us now with more. Dan.
Yeah, that's right, Josh. This is kind of a unprecedented experience, I assume, for OpenAI. I mean, they came into the kind of generative AI generation as the leader. Once ChatGPT hit the market in November 2022, they just kind of had a hold of everything. And now we're starting to see competition creep up, this in the form of Google's Gemini 3. Anthropic launched its most recent version of Claude. It's Claude Opus 4.5. And both of those can go toe-to-toe with what OpenAI has as far as its own GPT offerings. And so now the question becomes, okay, well, we're no longer, or we're beginning to see the era where OpenAI isn't the current leader when it comes to AI. What does that then mean for the company? Well, it appears as though, according to this report, that Sam Altman wants to double down on building out their capabilities and perhaps not focus as much on expanding their offerings over time, at least in the interim, with whether that goes from ads and things of that nature. Now, there's a question of, okay, well, you're going to have to generate revenue at some point. How are you going to do that? Be without ads or things along those lines? And I'm not Sam Altman. I can't answer that question. I'm also not the investors who are putting all of that money into OpenAI. And so, I think at this point, there's a lot of talk of, okay, that they're seeing this kind of red alert. But to be fair as well, we've seen these kind of cycles come and go with the AI companies where, OpenAI does well. Okay, well then Google comes and does well, and then Anthropic comes and does well, and then Meta comes and does well, and kind of on and on and on. And so it's as though we're just going to continue to see this kind of cycle. I think right now it's just that Google has managed to catch up after being seen as kind of an also-ran when ChatGPT launched, despite the fact that they helped develop the transformer technology that underpins all of this.
There was a few different AI headlines today. So we're talking here about Sam Altman going code red, and then we saw other headlines: Apple shaking up its AI ranks, Amazon unveiling the new chips. When you saw all these headlines, Dan, I mean, does it all sort of signal to you possibly anything, if at all, about maybe this new phase of the broader AI race?
It could be that it's just, we're in a maturing portion of that. When everyone was kind of coming out with their models, it was, so exciting, and it's still exciting. Yeah. But, we've since seen a number of models come and then be replaced by newer models. And so I think, that's kind of not exactly the fun part of it anymore. Especially if you're OpenAI and you're looking at Gemini 3 or you're looking at Claude Opus. But, I do think it just shows that this market is not necessarily maturing as, something like the smartphone market, but maturing in a sense where people are paying more attention to the more common minutia of it, rather than just saying, wow, look at this cool AI thing. It's okay. So, we've talked about how you're going to make money. Now you're trying to optimize. Now we're talking about more chips. So it's becoming more of a broader discussion rather than just the gee whiz. You can ask this thing a question and it can pretend that it's, talking to you like your friend. I think that's kind of where we are at this point. Amazon catching up as well. Again, they were also seen as an also ran even further behind Google, just because they didn't really have their own model that they were working on. They do have their own Nova models, but not up to snuff when it comes to ChatGPT or Gemini or Meta's Llama. But now they're starting to get a lot more play because they have OpenAI on their Bedrock, they have Llama on their Bedrock, so they have Claude on their Bedrock platform. So they're getting a lot more attention as of late. And I think that's, kind of, like I said, where we are in this kind of space when it comes to AI.
Dan, thank you, buddy. U.S. auto sales for November rolling in on Tuesday. Ford, Hyundai showing a decline in year-over-year sales, while Kia up 7% from the previous year. For more, we're bringing in now Aaron Keating, executive analyst at Cox Automotive. Aaron, always good to see you. So let's start big picture here, Aaron. You estimate November sales coming in at 15.7 million, Aaron. So that sounds like a bit better than October, but also down from a year ago. Start there, Aaron. What explains that?
Hey, Josh, thanks for having me. It's always good to see you. I mean, I think we knew that we had a bunch of pull ahead demand come into the market. July, August, September, we knew that the EV credits were going to start to roll out. And we just saw a lot more activity in the showrooms leading into that September 30th deadline. And we expected that October would drop off. We absolutely saw it, especially in the EV market. We saw a 50% decline, nearly 50% decline in the EV sales. And so there's nothing really alarming to me that we're seeing in the sales results this month, other than what we expected might be softening. We still expect that the end of the year will land. We're at a year-to-date pace, selling pace at around 16.2, which is still higher than what it was in 2024. So it's not terribly pessimistic.
So what are the kind of vehicles, Aaron, that are popular right now, that are selling relatively well in this environment?
Yeah, I mean, for sure. America has shown for over a decade that it's the SUV and the big trucks that are continuing to be the things that the Americans want to buy. And, some of that is starting to move maybe mid-market. So while the Ford F-150 slid back just a little bit this past month, we saw the Maverick and the Ranger really do well. So some consumers are still looking at what they want in utility, but maybe going a little bit smaller. Same with the SUVs, mid-size, full-size SUVs. They're still really great sellers. Cars we're continuing to see, they're not dead, but they are diminishing, even though Honda and Toyota still reliably push out a ton of those, thousands of them a month. But yeah, rest assured, the American consumer is focused on the bigger, the better.
All right, Americans love their trucks. We know that. You do mention here, Aaron, compact and mid-sized car sales. They keep slipping, though. What do you see there now and ahead?
Yeah, I mean, I think they'll continue to slip just merely because this market is not continuing to hold them up. I mean, I loved what Ali was talking about, the K-shaped economy. We really continue to focus on that as well. And those well-heeled consumers in that upper funnel of the K are still the consumers that really like those large vehicles. And so we're going to continue to see a decline, I think, in the sedans and cars. Again, reliable Honda, Toyota will continue kicking those out. They have a substantial amount of loyalty base that is focused on those cars. But otherwise, most manufacturers, especially the domestics, will continue to pull away from that segment.
What about tariffs, Aaron? I'm curious, you have such a great view of the industry as a whole. How are automakers continuing to sort of navigate that dynamic?
It's still a complicated picture. I think a lot of people almost forgot that they existed because we really just weren't seeing the price increases that we expected. Right now, we're sitting at about 4% year over year price increase. 3% of that's probably inflationary that we should expect. So maybe about 1% of that is creeping in as the tariff showing up in the model year 26 pricing. But for the most part, a lot of the manufacturers are feeling not on firm ground, but I'd say on relatively firm sand, if you will. I mean, a lot of the numbers have come out. They know what their effective tariff rate is for most countries. The big wild card for 26 is going to be the USMCA negotiations, which have not been completed and will have a massive impact on the North American automotive industry if anything should really shift in a wrong direction there. But otherwise, we've seen the tariff impact be fairly muted. We're seeing it show up in destination and handling fees. There will be some shrinkflation, if you will. So, selling the same identical trims, but with less, content within the cars so that they can hold price without maybe having to offer as much to the consumer. So those are the little ways we're seeing some of the tariff impacts sneak in.
You mentioned, Aaron, the EV market. I'm just curious, when you see these headlines about how prices at the pump continue to fall, Aaron, so the headline today, we dropped below a 3 handle. How do you think that, if at all, plays into EV demand?
I think for the foreseeable future, gas prices just aren't, we've seen it. They're not a main driver for adoption of electric vehicles. Most people, when they're considering electric vehicles to this point, have been very tech forward. Consumers have been consumers that are looking at it, maybe from an environmental perspective. The rubber hits the road once you get behind the seat of one of these things. The performance is there. The vehicles are becoming more mainstream in their looks, their feel, their technology, and so forth. So I don't know that gas prices is going to start driving those decisions heavily until a couple of years down the road when we actually have more vehicles on the ground. I think I continue to say the Bader-Meinhof phenomenon is there now. We've just pushed a ton of EVs into the market. So left and right of your neighborhood, you might start seeing more EVs show up, and that's going to continue to drive some organic demand. But I'm not convinced that gas prices is what should be considered as a driver for electric vehicle adoption at this point.
Aaron, always great to have you on the show. Thank you.
Yeah, thank you.
Coming up, I speak to the CEO of a health insurance startup that just gained unicorn status. Don't go anywhere. Securities and Exchange Commission Chair Paul Atkins looking to make it easier for companies to go public. And senior reporter David Hollerith is here with more. David.
Hey, Josh. So the new chair, the Trump appointee, Paul Atkins, has been talking about wanting to make it easier for companies to go public.
Make IPOs great again.
Yeah, for some time now. And today he was at the New York Stock Exchange, and shortly after ringing the opening bell, he kind of gave a few more details. And today he specifically talked about shrinking the amount of public disclosures that companies need to give out. Now, broadly, it's not clear what that means other than to focus more on material financial information. So to us, it sounds like focusing, having companies not required to file as much ESG related topics, but also specifically, he focused on smaller companies and talking about a scaled approach to public disclosures. Now, this could mean for newer and smaller companies that are public of a certain size, they would have less kind of reporting requirements. And we don't know quite what that means yet, but it could be fairly significant. And the whole goal here is to reduce the regulatory costs to make it easier to go public. We don't know how effective that's going to be at this point, but this is kind of one part of the three-leg stool to make IPOs great again. And that's what the chair had to say today about it. Part of this is also a little bit delayed given the government shutdown, which has kind of put the SEC's timeline for what they've been wanting to accomplish a little bit further into 2026.
What about this hot talk also, David, of the SEC, so changing rules, allow companies to only report twice per year? What's the story there?
Yeah, that's an interesting one. I've spoken to a source today who's sort of said that idea is being fast-tracked, and that a lot of corporate attorneys who represent companies are kind of preparing for that reality. Now, whenever that change, if it were to happen, if the SEC is able to move from a 4 times a year to 4 times a year to 2 times a year reporting requirements, companies don't have to follow it immediately, but they have to be prepared to change, and ultimately could be cheaper and easier for them, obviously less transparent for investors. But it opens a whole realm of kind of confusing things like public speeches. If you're only reporting twice per year, every time a CEO speaks, do they need to disclose that? So there's a lot of unanswered questions there. But it sounds like the talk is that it could be fast-tracked.
Wow. All right, David, thank you, sir. Appreciate it. Well, shifting gears to the startup space, health insurer Curative announcing a new fundraising round, bringing its valuation to unicorn status, meaning above $1 billion. And the company is looking to disrupt the insurance industry with a focus on preventative care. Joining me now is Fred Turner, co-founder and CEO of Curative. Fred, it is good to see you. So let's get right to this headline. You raised $150 million, Fred. I'm impressed by the A-list investors here. You got Druckenmiller, I see Novogratz. These are big guys. Walk us through the news and how you intend to put this money to work, Fred.
Yeah, thanks for having me on, Josh. So we're excited to announce today our Series B round in Curative, 150 million at a 1.3 billion valuation to really keep scaling our model of employer-sponsored health insurance that actually focuses on prevention. So we use a combination of engagement and preventative health to really get our members to engage as early as possible, go and take care of themselves. And we see that then translate into results, about a 30% reduction in inpatient hospital admissions within 6 months of an employer group moving to the Curative model. So we're planning to use this funding to continue scaling up. We started the health insurance business about 3 years ago now. And currently we're operating in Texas, Florida, and Georgia. And we're planning to use this funding to scale up nationally. So we'll be starting first in Maryland and DC, but looking to launch in Indiana, Ohio, and hopefully New York. And then over the next couple of years, roll this out nationally. You
talk, Fred, here about how AI-driven member experience is a big investment area. Just walk me through that a bit more, Fred. I mean, where do you see the significant automation coming?
Yeah, I think it's a really exciting time to be building in the insurance space. Yeah, it's usually maybe not considered the most exciting market, but it's an incredibly document and interaction heavy industry, right? We, even as a small insurance company, receive 10,000 pages worth of faxes every single day. And so historically, you would have these vast, office buildings of people manually working through this. And that leads to very slow responsiveness from members. It takes a long time to get anything done dealing with an insurance company. And what we're finding now is that if you build from the ground up in the age of AI, you can design those processes to be AI first. So you're not having people manually reviewing thousands of pages. We can get faster decisions, and we can really make the entire experience much more user-friendly, and really focus on the product that we're actually delivering to the consumer at the end of the day.
Fred, it looks like you have this zero out-of-pocket plan. Walk me through that, Fred. Just explain that model to me, and what are the unit economics at play, Fred, that sort of make that sustainable?
Yeah, so there's, I think, long been this idea that we have to put in place these barriers to people seeking care, otherwise people will dramatically overutilize. But the data in the literature has really shown that the opposite is almost true. That when you put in place these barriers, deductibles, copays that are supposed to make people good consumers, so that they'll go and price shop, only get the necessary care, it's just not what really happens in reality. When you put in place those barriers for people, what happens is they just stop seeking all care. They don't go do the preventative visit. They don't go do the screenings. They don't go get their colonoscopy or their mammogram. They put all that stuff off because they want to avoid the out-of-pocket cost, or even the perceived out-of-pocket cost if it would maybe have been free as a preventative service. And they delay and delay and delay until what could have been a simple, straightforward intervention is now becoming a more expensive procedure, an expensive specialty medication, or even an inpatient hospital stay. And so by creating that financial barrier, what you're really doing is just kicking the can down the road and saying, well, we won't spend any money now on prevention, but we're going to spend a lot more money next year or the year after actually dealing with the consequences of that. And so what we do with Curative is we remove those financial barriers. So on day one, our members have no out-of-pocket costs, no copays, no deductibles, no coinsurance. They can actually go and get care, and they know what it's going to cost them. And everybody gets that for the first 120 days on the plan. And then during that 120 days, they have to come to us and do a preventative health visit, which we call the baseline visit. And as long as they show up and do that preventative health visit just once a year, they get to keep the no out-of-pocket for the rest of the year. But if they don't show up, on the 121st day, they go back to a $5,000 deductible, 20% coinsurance, and a bunch of copays. And so we're able to get 98% of members to actually engage, show up, and do that preventative visit. And that's really what allows us to drive the effective intervention with those members.
You note here too, Fred, you have reached profitability. I'm curious how durable, Fred, you think that profitability is as you're now, building, investing, and scaling.
Yeah, we expect to continue being profitable and to grow the profitability of the business going forward. I think obviously in insurance, it's very much a scale game. You have to reach a certain scale before it's possible to be profitable. So we've been growing rapidly and investing, over the last few years in getting to that profitability. We're now about 165,000 members on the plan, but we grew 100% this year. So we're hoping to keep that growth rate going, but do it in a profitable and sustainable way.
What do you think, Fred? Last question. Ultimately, what's the exit strategy here? Is it IPO, Fred? Strategic acquirer? What do you think?
Yeah, we're looking to build a big insurance business. I think there's a gap in the market for a plan that is really focused on prevention and building something that the end consumer actually wants to have as a product. I think health insurance is this strange part of the market where we spend so much per year on the product and then are generally dissatisfied with it. I think most other areas of the economy, when you spend $10,000 a year, you're generally pretty happy, or at least understand the value you're getting from that investment. And I think we're kind of reached this breaking point with health insurance where people are not happy with what they're getting. And I think there's a gap in the market for a new large health plan that provides that preventative care and that consumer experience that people are looking for. So Fred, we're not looking to sell out anytime soon.
Fred, great to have you on the show today, sir. Thanks for your time.
Thanks.
Coming up, we get a look at some of the top trending tickers on Yahoo Finance. Now time for some of today's trending tickers. Beta Technologies, Warner Brothers Discovery, and Estee Lauder. Starting with Beta Technologies here, securing a $1 billion 10-year deal with Eve Air Mobility for Eve to be buying motors from Beta. Beta shares jumping on the news. The stock is down to over 16% since debuted on the New York Stock Exchange just last month, as eVTOL companies await FAA approval and potential government contracts. Next, Warner Brothers Discovery trading at a 52-week high as the company fields bids from its biggest media rivals. Paramount, Skydance, Netflix, and Comcast have all put in their second round of offers. Netflix submitting a mostly cash bid for WBD's entertainment and streaming business. It's according to the Wall Street Journal. Comcast also just interested in parts of the company, namely the studios and streaming service. Meanwhile, PSKY is going for the whole thing with an offer backed by 3 Middle Eastern wealth funds. That's according to Variety. Finally, beauty company Estee Lauder, they have created an AI scent advisor to make suggestions to online shoppers. The AI tool is powered by Google's Gemini models. Estee Lauder reporting that those who used the tool had double the purchase rate of those who didn't use it. Well, Strategy has established a $1.44 billion cash reserve to cover its dividend for 21 months. Company's CEO Phong Le joined Market Catalyst to discuss this decision, their Bitcoin buying strategy, and more.
We have a Bitcoin reserve for the purpose of the long term of the business. And now we've built a US dollar reserve for the purpose of the short term of the business. We don't want to be in a position to sell Bitcoin, but below 1x MNAV, it doesn't make sense for us to issue equity to pay off our dividends. We built up $1.44 billion. We will target 2+ years of cash reserves, if you will, US dollar reserves, so we don't have to sell Bitcoin. Let's say that gets us to 3 years. If there is literally a 3-year sustained Bitcoin down cycle, a 3-year sustained cycle where MNAV trades below 1x, then we may have to sell Bitcoin. At this point in time, it's the end of 2025. We're talking about 2029 where that may be the case. And we have the Bitcoin for a reason, to protect the company, to protect our shareholders. And if we have to sell it, we will.
And the cash that you all put into this reserve, this $1.4 billion reserve, is the cash that you have raised from selling shares, correct?
That's correct. It's from selling equity at a premium to MNAV, which by definition is accretive to our shareholders.
And of course, you have now embarked on a more recent strategy where you have been issuing various types of preferred shares and getting cash from that. They're sort of more credit-like instruments. We've talked to Executive Chairman Michael Saylor about that. What is sort of your capital raising plan for the rest of this year and going into 2026 when it comes to selling either the common equity or more types of this preferred equity?
Yeah, our preference is to increase our amplification by selling more preferred equity. We really just started this in January this year, and the idea of a perpetual preferred to buy Bitcoin is a pretty novel idea. Look, it's as novel as in 2020 when we said we were going to become the first Bitcoin treasury company. It took, I would say, about a year for people to understand what we were doing. Then we layered debt on top of that, and we became a Bitcoin treasury company that leveraged ourselves. And that took people a year, 18, 24 months to figure that out. And now we're issuing perpetual preferred, which we think is superior for a variety of reasons to traditional debt, to convertible debt. It's going to take 18, 24 months for the market to figure this out. But it's not just the market understanding what MSTR is doing. It's the market understanding that a perpetual preferred instrument that pays 10 and now three quarters a point, that's STRC, is better than other alternative things that you might be able to invest in. So it's going to take a while to season the market. It could be a year, 2 years, 3 years. At that point in time, I think we'll be able to really grow a lot of capital through our perpetual preferreds. The big challenge people had with them was how we're going to pay the dividends in the short term if we see volatility in Bitcoin, volatility in MSTR. Now we've created this US dollar reserve to address that challenge.
I'm also curious when it comes to your Bitcoin buying strategy. You guys have pretty consistently bought that Bitcoin, and it seemed pretty price agnostic. Is there any thought of going forward? I mean, listen, everybody says it's tough to time the market. I get it. But like, buying lower is better than buying higher as a general rule of thumb. So is there any sort of plan going forward to try to maybe not buy more on the higher side and more buy? I mean, I think that your average cost to purchase at this point is above where the price of Bitcoin is right now, if I'm not mistaken.
Yeah, I split buyers into sophisticated buyers into two categories. You have investors and you have traders. Traders are PhDs working at hedge funds who have, large desks with 4 screens in front of them, and they're making decisions at the millisecond level of when to buy and sell Bitcoin or buy and sell equities or derivatives, et cetera. That's not us. We're investors. And when you see an asset class like Bitcoin and you believe in it, you just buy it when you're able to raise capital to buy it. And that's our strategy, right? We are not Bitcoin traders, we're Bitcoin investors, and that's the distinction there. I'm pretty sure that if I tried to become a Bitcoin trader, I would lose to more sophisticated Bitcoin traders. So we just buy when we have excess capital or when we're able to raise capital.
So Fang, as we talked about, Bitcoin is going up today, right? It's been on this downswing recently. But when you do sort of scenario preparation, simulation, what have you, and you think about Bitcoin going to 80,000 or even going to 60,000 or even going to 40,000 or lower, what would these various levels mean for your ability to pay that dividend?
I think there's two things. There's Bitcoin price, and then there's this price of our equity, which drives MNAV, right? And we've seen this in previous scenarios where Bitcoin price goes down, it has a massive drawdown, but our MNAV is still above 1. And so it's accretive to our shareholders to issue equity, to pay dividends, to buy Bitcoin. And so, in fact, let's say Bitcoin price, hypothetically, hope it doesn't, goes to 40K, and our MNAV is 2x. It's actually more accretive to buy Bitcoin, issue equity to buy Bitcoin, and MNAV of 2x when Bitcoin is 40K. So that's sort of probably the primary difference here. It's not just a function of Bitcoin price, it's a function of our equity price. And then, the big question becomes, well, what drives your MNAV? Right. And what drives our MNAV is the ability for us to be accretive in adding Bitcoin per share. Right. Do people believe that we can add Bitcoin per share? Can we raise more capital either through equity financing or debt financing or now preferred financing? And do they believe that the management team is doing things in a thoughtful way and a transparent way? So that's what we really focus on. And so, I think when Bitcoin price goes down, we see that as a buying opportunity as long as we feel bullish about the enterprise overall.
We're wrapping up today's Market Domination. Don't go anywhere. We've got you covered with all the action. Following the closing bell, stay tuned for Market Domination Overtime.